Individuals must aim for proper investing as one of the essential strategies. Stocks are a fantastic financial instrument that can generate profits for individuals in various ways. On the other hand, reading stocks might be difficult for a layperson or a newbie. It's mainly because they don't know how to get things started. So, if you are a beginner, this guide will help you read the stock chart. Keep watching until the end. Hello guys! Once again, welcome to Financial and Investment Wisdom. Today, we will discuss the beginner's guide to reading a stock chart. This video will be very informative, so don't forget to leave a like and subscribe to our channel. Let's get started on today's topic. A stock chart is a graph that shows the price of a stock over time. Knowing how to evaluate this data can help us identify risks, trends, and opportunities in the investment world. For example, you can get information into a stock's seasonality, sensitivity to change, volatility, and risk by learning how to read a stock chart. Technical analysis, a more advanced approach to evaluating stock prices to predict how they will change in the future, can also be improved by stock chart data. A stock chart illustrates the price of a stock over a period of time. You can look for further details such as the current price and historical rates, and predict its future direction. Many aspects of the chart, like the time range and chart type, can be changed for easy analysis. To invest in better stocks, traders must first learn to read stock charts to compare data and perform financial analysis. Without the proper knowledge, they will most likely lose money in the stock market. So, let's get started with some practical steps. The first step is finding the trend line. It's the orange line that appears on the stock chart every time the stock goes up or down. A stock's price might rise or fall dramatically. A trader or investor should not respond negatively or positively to substantial drops or gains. Instead, this trend line should be used to determine what is happening in the market concerning a specific stock. In addition, this trend line helps in future analysis. Any stock-related news will come and go, but when news occurs in real time, the trend line shifts rapidly, demanding immediate attention. As a result, when investing in stocks, the trend line should be used as a high indicator line. Step 2. Look for resistance and support lines. The next step is to analyze a chart that depicts resistance and support lines. The levels are the prices at which the stock has maintained for a given amount of time. A support level is a price below which stock is unlikely to fall, while a resistance level is a price above which stock is unlikely to rise. Unless there is a significant shift in the market, such as a decreased marginal profit, the level of resistance and support is unlikely to change. A stock's price swings back and forth between inflated support and resistance levels. The primary function of resistance and support levels is to determine when to buy and sell a stock. These levels are subjective, and various people will interpret them differently. Support and resistance lines may not be important if a stock is held for an extended period, but they may be essential for a short-term investor. Step 3. Identify when the dividend and stock splits will take place. At the bottom of a stock chart, you can see if and when the company has paid a dividend, as well as whether or not there has ever been a stock split. The shareholder receives a marginal profit when the company's board of directors decides to pay its earnings share to its shareholders in the form of dividends. Although not all companies pay dividends, the absence of dividends should not be taken as a sign that the company is not worth investing in. There are plenty of other aspects to consider. Some organizations, for example, prefer to reinvest their earnings rather than return them to shareholders so that they can concentrate on growth. A stock split is a strategic choice made by the company's board of directors to issue extra shares to the general public. It does not affect the company's value, but it does affect its price. In general, companies use a stock split to attract small investors when the share price falls below or equal to a competitor's price. Step 4. Price and volume comparisons. Users frequently make mistakes in stock valuation by focusing just on the price. To accurately see market activity, always undertake a comparative price and volume analysis. A low-volume stock with an exceptional rise, for example, could be a fake spike. Similarly, a slight drop in a low-volume stock does not always mean underperformance. It could also indicate that the investors are waiting for the appropriate opportunity to sell. When undertaking chart analysis, paying attention to these aspects will ensure that you read them correctly. Step 5. Ensure that all of the facts in the chart are covered. Profitable businesses will occasionally pay dividends to shareholders on their stock holdings. It's worth noting that this isn't always the case. Other businesses believe in reinvesting profits and concentrating on long-term growth. Both types of businesses are excellent investments. To make smarter financial selections, you must consider the trend and how it relates to your goals. Do you want to make a longer-term investment? If so, focus on growth stocks. If not, dividend-paying equities are an excellent option. You should keep a close eye on the stock charts to better guide yourself. Another company technique that allows more shares than the prior holding is the stock split. Using this strategy, the company attracts more investors, thereby increasing the demand and the share price in the future. Step 6. Don't forget to include the summary key. To invest in the stock market, beginners must first decode the stock chart using the summary key. It briefly summarizes the volume of stock traded, moving average, current price, and so on. So guys, do you have any questions so far? Let us know in the comment section, and don't forget to leave a like and subscribe to the channel to keep watching for more informative content in the future. Now, let's understand the different types of charts. The first is a line chart, which is the most common type of chart used to monitor daily stock values. It's a line that shows every price movement between the stock's opening and closing price for the day. The second chart is a point and figure chart. Unlike a time-based chart, this chart depicts price changes in direction. The X's indicate price increases, while the O's represent stock price decreases. The third chart is the bar chart, which is the most popular among traders. It indicates the day's opening, closing, as well as the highest and lowest price levels. It provides a daily summary of stock price fluctuations. The fourth chart is the candlestick chart, which has a unique structure with two lines and a broad body. The thin lines show price movements, while the body figures out the difference between the opening and closing prices. Finally, the head and shoulders chart comes in at number 5. On either side of the graph, it has the shape of a head and shoulders. The peak of the rising trend is the highest point, and it indicates that the upward trend will soon come to an end. The reverse chart pattern is what investors refer to it as. So guys, it's crucial to analyze and interpret stock charts to understand and explain future charts and determine your stock's state. Unfortunately, there are a lot of charts, and it isn't easy to take them all in at once. As a result, you can rely on various stock trading tools to provide a better perspective. Some trading platforms, such as TD Ameritrade, E-Trade, and Robinhood, offer outstanding tools and expert insight into stock chart research. These are some of the investment methods that can be used during a recession. Above all, keep in mind that the stock market is highly speculative. Things may not be the same in the future, even if you study the trends and read the charts. Understanding is preferable to buying blindly in a broad market with numerous changes and the pink economy on the rise. At Financial and Investment Wisdom, we focus on providing you with the most up-to-date information on the current subjects in any major finance field. Also, we value both your feedback and suggestions, so please share them in the section below. Before we wrap up, leave a thumbs up for this video and subscribe to Financial and Investment Wisdom to watch more incredible videos in the future. Please stay connected with us. See you in the next video. Bye!